now have Matthew Leibowitz take us through the sources of finance. We're delighted to have you, Matthew. Matthew joined Plaza Ventures as a partner in 2012. Throughout his career, he's been involved in all aspects of investment cycle. He's completed dozens of transactions of early-stage technology companies. He was formerly principal with an institutional investment firm in Toronto. He focuses on origination, vetting, due diligence, negotiation, and deal structuring of investments and private equity financing agreements across technology sectors, as well as the refining of business concepts, selecting appropriate business plans for investment, and monitoring and enhancing the performance of portfolio companies. He's a frequent speaker at various conferences. He holds a Master's of Law from University of Oxford and the University of Kent, a Master of Science degree in International Sustainable Development and Investment from the University of New South Wales, and he also has an Honours Bachelor of Arts from the University of Toronto. He is a frequent judge at many competitions that I have seen. Please help me welcome Matthew Leibowitz.
How's this thing work? Oops. Okay. You guys hear me okay? I hate standing behind these things. Why don't I just come out here? Sorry if you have to follow me. I move around a little bit. So I'm Matt. I'm a partner at Plaza Corp Ventures. First of all, thank you very much for having me. It's a pleasure, honor to be here. Appreciate it. Okay, so just very quickly, I've got a brief bio on who I am. So Matt, partner at Plaza Corp Ventures, background, legal finance background. I've worked on dozens of transactions, the full spectrum of venture capital, private equity, sit on numerous boards, advisory boards for early stage technology companies, involved with a number of charities that I'm on the board of directors for, and this, that, and the other. I'm the investor in residence at Venture Lab, which is part of one of the RICs. It's sort of like the Mars of York region, and involved with one of the mentors of Next 36 and a Jolt and a couple of the other things as well. So tend to be busy from time to time. So just a little bit about Plaza Corp. So some of you may have seen our signs on various street corners, on buildings across the GTA. So we are a condo developer. We started in the early 1980s, late 1970s. We're one of Canada's largest condo developers. It's founded by Anthony Heller and David Bronkman. Initially focused on shopping centers and whatnot, but then exclusively focused on condos in 1986. We've completed over 30 projects to date. We've got some of the industry best resale value. We currently have 12 projects on the go right now, totaling about $4 billion in development, give or take. We're riding the condo boom right now. It's been a lot of fun. We've been consistently profitable and a strong track record and strong outlook. Very bullish on the outlook, irrespective of what you're reading in the papers these days on the condo market. So why am I here? Well, frankly, the families behind Plaza Corp have been focused on making a number of early stage investments for many, many, many years. Some have worked out tremendously well. Some have been not as well, which is generally the game and how it goes. But in roughly 2008, one of the sons, Daniel, my partner Daniel, who was practicing corporate securities M&A law in New York, focused on early stage technology companies, said to his dad, he said, "Dad, the companies that were investing in the ones that we're more actively involved in, well, those are the ones that we're generally getting better returns on, versus the ones that were more passive, back of the napkin type of investments." So they formalized a group in 2008 with my other partner, Rob, who's a great technologist and has built and sold a number of software companies in the past, and just an overall great guy. So Daniel and Rob formed the practice in 2008. And so about Plaza Corp Ventures, so we ostensibly co-invest with other investors, both in Canada and in the United States. We have a sort of a diverse background of investment, so we basically, as Jared mentioned, we look for low execution risk and scalable business models. At the end of the day, I always say this, you can always have the best piece of software in the world, but unless you have the right people to build that company and grow that company, ultimately that's the most important thing. So we spend a lot of time diligencing the management teams of companies that we look to invest in. We generally have a unique niche in the market space in the sense that we're not a traditional fund, so we generally fill the gap between angel rounds and later stage VC, which of course I'll get into in a moment. We have a strong record of exits in some of our portfolio companies. I don't know if you're familiar with any of them right now, but these are all at various stages of development, and I'll talk about one of them in particular later on in my presentation. We've had several successful M&A in public marketplace in both Canada and the United States. So we have a lot of fun. So what's the Canadian venture capital landscape looking like? Well, there's some good news and some bad news, so get ready, okay? So I got this report. It's online. It's a Thomson Reuters publication. They publish it every year about the state of venture capital in Canada. So you can kind of see, I hope everyone can see well. So you can kind of see what's been going on with the numbers. So you can see in Q1 2008, wow, look at that, over $500 million going on in deals. Okay, that's fantastic. And then obviously most people are sure aware of what happened in 2008 with the markets crashing and whatnot in the recession. And so everything dipped. And it's really now only starting to peter back a little bit. But it's not all as good as it looks like. It's still pretty bad out there. So that's what's happened, is that there's been a complete correction in the Canadian venture capital and private equity landscape. It's a little sad, but in the long run, I actually think it's a very healthy thing. In every industry that's very cyclical, and we'll see that as well too, additional trends. So again, but the good news is that, this is a 2011 report. I have some numbers on 2012, which we'll also see at the end. But so this is bearing in mind up until 2011. So look, there's some good news. You can see that those two lines are going upwards. That's positive. I don't know what it means, but it means that it's positive. So if you believe the numbers, we're going in the right direction. I don't know how long that's going to last, but at least it's going north. So that's positive. So as you can look, there's 444 Canadian companies funded by venture capital in 2011, which is a 6-year high, which is great. I don't know what the numbers are going to come in this year or next year. I can't predict these things, but at least we're heading in the right direction. This I find very interesting. So what you'll see is that if you're familiar with the traditional venture capital landscape, we had a lot of retail funds that were landed. They basically around in sort of the late 90s and early 2000s, and they were the old guard of venture capital in Canada, if you will. And whoops, sorry, let me just go back. I hit the button by accident. So what you can see is they were mainly the retail, which is, I believe, this square here. It's hard to tell, but and then of course foreign is usually U.S. investors. And so what you'll see is that these were these retail funds that were around, and now that's going away essentially. What you're seeing is the rise of these private funds, which I'll also get into in a minute or two. And that's been a complete sort of landscape shift in who's out there and who's investing. So I think that's something to watch and something that's very interesting. And so with that in mind, what's unique, and of course Jared mentioned this as well too, a lot of investors now, there's also some good news for you as in terms of the entrepreneurs. It's never been more capital efficient to start a technology company. We can invest in a company today for whatever, $500,000, and that same company 5, 6, 7 years ago would have required $3 or $4 million just to build what they do. But now there's so many free tools that you can utilize and so many new software products that are available. The barriers to entry have never been lower, which is fantastic, I think, for entrepreneurs in Canada. And obviously from an investor, hopefully we can get more bang for our buck. So this is a very unique trend. And of course what Jared mentioned is that there's been a focus on SaaS companies, and that acronym is software as a service. It's basically selling you, instead of what they used to do in the 90s and early 2000s, is they'd sell you a piece of software, they'd have 40 people show up at your institution and implement software on your desktop across 40 or 50 or however many desktops that you had. Now what people are doing is they're ostensibly just renting the software online. And it's a much more capital efficient, the margins are much better, and it's a recurring revenue model. So this is what a lot of investors have been focusing on recently. And now, of course, at the end of the day, well, why are we all in this? Well, we're in this for the exits. We're in this to make money, right? So the exits, as you can see, and these numbers, like, you know, these aren't just the numbers. It's more about quality versus quantity, right? So, you know, it's what would you rather have? 50 exits at $1 million each, or one exit at $100 million? You guys do the math. So, you know, it's not necessarily about quality. It's about quantity. It's about quality. So we've been seeing a bit of an uptick in some quality deals. And 2010 was was a bit of an anomaly because there was a couple really big IPOs and a couple tech companies here in Canada, so that's why it peaked like that. So it's been pretty interesting. So again, the good news is that U.S. companies or U.S. buyers who are most of the buyers of Canadian technology companies, they're really starting to focus on Canada right now, at least from what I've seen. There's not a big uptick in M&A, but at least now basically I'll put it to you this way, the Canadian or U.S. buyers are starting to really take Canadian companies seriously. We're not just some, forget about those guys. They're actually really, really impressed, and I speak to them almost on a daily basis. So they've got a lot of people up here looking for new deals. It's pretty exciting, actually. So obviously something to be very hopeful about. So where do you guys want to get money, right? That's why we're all that's why you become entrepreneurs. It's part of growing the business. In most of the situations, it's inevitable that you have to go out and raise money somewhere. So let's talk about where you guys want to get money from. Well, usually it's your friends, your family, and fools, right? So these are people like, your rich neighbor, your uncle, people like that. So that's what usually when you're starting a company, it's yourself that usually starts the business. You put an X amount of your dollars, you're saving, people mortgage their house, they do whatever they can if they're really passionate about it, and then eventually maybe that money dries up. Well, then what do? You speak to your uncle, you speak to your cousin, you speak to whatever. And that's basically what you do, and this is called, this is even before a seed round. This is friends and founders, friends, family, and founders and fools. So this is really interesting. So that's generally the first place that people go when they're looking to raise money. And then, well, there's things like incubators, and of course, Jared, there was a question about Jolt, so there's Jolt on this list. So these are just a few of the incubators here in Toronto. So there's Extreme Startups, which we're an LP in. There's Incubes, there's Jolt, there's Communitech in Kitchener and Waterloo, and Digital Media Zone, which is part of Ryerson, and then of course Venture Lab. So these are all various programs. Some, Venture Lab is a government one, and the rest are all private, I believe. And so these are all various programs that you can apply to, and if you have an idea, some of the companies are further along than others. It really just depends on the stage, and each incubator or accelerator, whatever you want to call them, are all a little bit different. They all have their own certain criteria. And of course, I can opine all these things for quite a while and give you some background on each and every one of them if you wish, but happy to do that offline if you want. And, this is, as far as I'm concerned, these are great places to go if you're sort of working on your business and you really need to take it to the next level. These are great places to go. They're great resources. For the most part, they're free. Some of them give you cash, some of them don't. Some of them take equity of your business, some of them don't. So they're all a little bit different. So what I would do is I would spend some time researching this landscape as well and figuring out which ones you want to apply to, and try and connect with folks that are running these things and have that access to some of the mentors that work there, or part of you that spend some time there and whatnot. So that's incubators, and we've just been seeing this rise of incubators in Toronto and in Canada this last 2 years. I don't remember any incubators 2 years ago. These guys are all new, so it's pretty interesting. So something's going on. And then you've got your angel investors, and that's Daddy Warbucks, by the way. I tried to get a higher res picture, but that was the best one that I could find. That's Daddy Warbucks from Annie, for Annie the musical. Anyways, so that's the guy those are angel investors. They're high net worth individuals. Some are passive, some are active. Some are, again, your uncle that's has a business and he's done well for himself, or maybe not, and maybe he's lent you some money, maybe he hasn't. So maybe he's active, maybe he's a strategic investor, maybe he's not. I don't know. And then there's passive angels, and then there's those are the guys or the individuals that'll just say, here's $50,000. I'm now a shareholder in your company where I've loaned you some money. Let me know how it goes, but I can't bring any value. Then there's other angel investors that come from the space, and maybe they can write a big check, maybe they can't, but they can really bring their expertise and their contacts. And if you had to choose which one, well, there's really no right answer necessarily in terms of which person is better, because sometimes it's good to just have money, and sometimes it's good to have money and advice too. And every situation is a little bit different. And then there's more formal angel networks. So these are groups of high net worth individuals, generally people from all sorts of different businesses. Some come from traditional businesses, some come from technology. It really just depends. It's the whole spectrum. So here's a few examples in sort of the GTA area, if you will. One is called Angel One Network. There's another one called York Angels, and another one called G10, which is Golden Triangle. They operate generally under the sort of Kitchener-Waterloo, Hamilton area. And then here in Toronto, we've got Maple Leaf Angels, and there's a whole bunch others. You can just go on to the NACO, which is the National Angel Council, or I forget what the acronym is. Yeah, whatever. NACO, just Google search NACO and you'll find NACO, and that's sort of the national organization that's the affiliated organization for all of these different groups. And they'll have a list of all of the different angel methods. But these are just a few angel networks, and I help out with some of these groups as well too. And then, so this is what interesting. If we go back about that other slide in terms of who the investors are, in terms of the foreign investors, retail, et cetera, this is probably one of the more unique things that I've seen in my career doing this, is what I call the rise of the micro VC. So these are guys like Daniel Klaas, Extreme Venture Partners, Matt Golden, and Boris Wirtz out of Vancouver, version 1. He just launched Mantella, and of course us. So these are the smaller funds that they may or may not have a unique niche that we look for in a type of deal, but we manage smaller funds, and we like it that way. We're not trying to be the big institutional investor. We're very hands-on, and we try and work directly with our portfolio companies. And we're a little bit more nimble. We're basically startup investors ourselves, in the sense that we take a lot of those philosophies and try and in terms of like building a startup company, and then try and work with these guys. And so these are all good friends of mine, and we share a lot of deals together. We co-invest together. And what I'm excited about, and why I'm happy to put my friends on these slides here, that I don't view them as competition. I view them as friends and co-investors. There's plenty of good opportunities to go around as far as I'm concerned. And to that end, we all have, like I said, different niches that we may or may not focus on. And we're all entrepreneurs ourselves, and that's really one of the key things to think about. And then, so now we've got sort of the larger, more institutional firms who are all actually these guys are all very active right now. And also I've got a lot of contacts, and there's some wonderful people at each and every one of these firms. These are generally the firms that are writing bigger checks with larger US VC firms. So we've got Innovi out of Montreal, Tandem also out of Montreal, but they've got a Toronto office. Best Funds, which is my alma mater, Row Ventures, also out of Montreal and Toronto. And then, of course, the BDC is very active in OMERS here in Toronto. And OMERS is a relatively new player on the scene. They've been around for maybe a year, give or take. And, of course, they're part of OMERS, which is the large pension fund here in Ontario. And they've been very active, and they're doing a whole spectrum of deals, everything from seed deals to writing checks for $20, $30, $40 million, and everything in between. But there's a lot of good momentum, and these are some of the main players right now in terms of doing deals, or more active players, I should say, in terms of writing larger checks in Canada. So this is the aforementioned sort of hot off the press slide that I was referring to. And so this is just for the Q3 2012. So this is like now, right? So as we can see, the fundraising basically hit a wall in the third quarter. Just $42 million was raised. That's from $42 million, according to a recent report from the Canadian Venture Capital Association. It's not a lot of money. That's a fraction of the 365 committed in Q3 2011. However, as of September 30th, there was $1.5 billion in new capital committed to VC funds this year. So that's a bit of a positive note as well, too. So that to me means that maybe 2013 and 2014 and 2015 are going to be more busy years. I don't know if that's going to be the case, but new money's been raised this year, so there's going to be an impetus to invest in new companies. And $1 billion raised in 2011, putting 2012 tracked to be the strongest year, blah, 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 blah. So, who knows if that's going to be the case. Again, as Jared mentioned, investors generally follow waves and whatnot. And, there's really no reason why that happens. It's really just a lot of market sentiment. Jared mentioned big data. Like, what does that mean? I have no idea. Like, what is it? Like, go figure. Like, every company is a little bit different. There's no ironclad rules in terms of what works, what doesn't work. What I will say, though, is that, this is very much a relationship business. Venture capital is very much a relationship business. We have to, at the end of the day, what I've always said and maintained is that, if things don't go well, you want to be in the trenches. You have to be in the trenches with that management team. So, just think about that context. You really want to know that you can trust that individual, and if things aren't going well, that you guys can, those individuals can work together and try and get themselves out of that situation. Because as I mentioned, at the end of the day, VCs really only make money once the company has grown and been acquired and whatnot. So that, again, we have a vested interest to build as much enterprise value in as a relatively quick period of time, and then sell the company as quickly as possible. So, at the end of the day, that's what it's really all about. So I just want to talk, not to do some self-promotion of one of our portfolio companies necessarily, wink, but this is one of our portfolio companies, Keek. So Keek to me is, I don't know if you guys have heard of it, I don't know if you've used it. It doesn't make any sense to me. We were the first investor in the company. We basically incubated the company. And this is a company that in a year and a half, in fact, I'm missing the party tonight because it was this evening right now because they're having a party to celebrate their 10 millionth user. In my career, I've never seen any growth like this. It's a consumer play. Ostensibly what it is it's think Twitter for YouTube plus Facebook. So it's a social platform that allows you to send a up to 36-second video of yourself from your smartphone or from your laptop computer, and with one push, you can then send that to everyone in your social network. So it's like having BBM chat essentially, but with video. So personally, I say this to people, and I hate that I'm going to be caught on record with this, but I don't use it. I don't understand it. But at the same token, I'm not the demographic that uses it. And generally, the demographic is teenagers, right? So maybe if I was a teenager, I think this is the greatest thing since sliced bread. But meanwhile, these people, the company's growing astronomically. I mean, every day they're signing up over 100,000 people. It's quite astronomical. And so now they just closed a very large round of financing. And again, this is just within a year and a half. And so now they're going to be going to, they're looking to go to the US and raise a significant amount of funding. And this might be one of the harder companies in Canada in the last few years. So basically take everything that I've said and throw it out the window with this company. And that's why I wanted to mention it, not for necessarily for self-promotion per se, but it's because it doesn't make any sense. It doesn't follow any of the trends of what typical investors look for. And yet it's going out there, it's growing, it's a consumer app. Okay, so it's like number 5 in the downloaded app store in the world. Like number 1 is Facebook and Twitter and Instagram, and then these guys. Like it's unbelievable. So it just doesn't make any sense to me. And if you guys can figure it out, I'd love to hear your interpretation of it and how it's grown viral. They haven't spent any money on marketing yet, and it's just
Are they profitable?
You generally have to generate revenue in order to turn a profit. So you can do the math on that one. And of course, it's a private company, so I can't give up too much information, but let's just say they're not profitable. But, so the point being is that just because you don't necessarily fit the mold, and again, what are most investors looking for these days? Well, they're looking for, SaaS, analytics, big data, again, whatever that means. So just because you don't necessarily fit into that boat, that doesn't mean that you're not going to be able to do something like this, okay? And so don't be discouraged. So there's a lot of folks out there. I think it's more about building a relationship with a potential investor. It takes a lot of time. It takes, sometimes, I'll just give you a quick example. Sometimes I've met a company and we'll start going right away, and then sometimes it takes 3-4 years to just build a relationship where the timing isn't right. And again, just to reflect what Jared said, I think it's always important. What I like is when companies do call me up and say, Matt, be upfront. I just want to be on your radar screen, okay? If you have 10 minutes, can I buy you a cup of coffee and just tell you about what I'm up to? And then these are the things I'm going to do. And then I want to come back to you in a year, 2 years, 3 years, whatever it is, and just show you that I've done it. And I think it's really important to build those relationships. You want to get on investors' radar screens. But again, most investors have severe ADD, myself included. So we do see a lot of deals. Like we'll see probably a couple thousand opportunities on an annual basis. Like, how do you start navigating those waters? And, so just be quick with what you're doing. Not to say that our time is more precious or more valuable than anyone. Just be very concise, be very metrics driven. What I love is when a company approaches me and they said, Matt, these are my numbers, these are my metrics, and when they're like spot on with their numbers. I love that. To me, that says to me that entrepreneur or that CEO or CFO or whomever, A, cares about their company, they're litigious, and that they're really focused on taking those metrics and knowing how to take our money and then spend the money in the right place based on those metrics. And I think that's very, very important. So when you're speaking with an investor, say, yes, I'm this kind of company, this is my customer acquisition, this is my LTV, the K efficient ratio, you can go on and on and on with these ratios. If you can rhyme them off, whether they're valid enough, at least it sounds good. And that's also half of the battle too, right? Whether or not they're real, I don't know, but we'll find out soon enough. So at least sound like you know what you're doing. And I think that's it. How's my time? I mean, I can ramble on for more if you want.
You have time for questions. Beautiful. This is in your portfolio, Matt?
Yes, it's one of our portfolios.
How did you decide to get it?
Well, it was brought to us by sort of someone that is working at the company that we had invested in, his previous company beforehand. And so they came into our office and we honestly took a total flyer on it. I'm still shocked that we did it because it's totally outside of our discipline, if you will. And so fortunately, it's one of the ones that, everyone, not everyone, but a lot of people that I speak to, they say, well, you must be thrilled, and da-da-da-da-da. And I said, well, it ain't over till it's over. And right now on paper, it's very exciting. But until the company's acquired or go public or whatever the case may be, until the check's in the bank, I'm not counting my chickens quite yet. And even once the check's in the bank, there's still ways of getting those checks back. So, you have to be very cognizant of these things as well, too.
I thought it was really interesting what you were saying about micro venture funds.
Yeah.
And I was curious to know, as an entrepreneur, why should I go to a micro fund versus a more traditional growth fund? How is the experience different? As well as, if I was, say, an investor, why would I invest in a micro venture fund versus a growth fund? What's differentiated about it?
Relationship. I think it's just a look and feel and touch and feel personal thing. I mean, with us, I can only really speak for myself and my experience, but with us, we're not trying to be a big fund, so we try and give our entrepreneurs and our management teams that we invest in a lot of hands-on work, again, because I only really make money as enterprise value is built and the company has been acquired or goes public. So for me, I'm not trying to manage a portfolio. I'm not just trying to click buttons all day long. So the anticipation is that, or the hope is that I'm going to be spending a lot more time with you to bring my expertise, if you will, to help build value. And that can be numerous things.
When you say that you make money last,
yes.
Is there an actual difference in terms of the investment terms? I mean, is a growth fund not making their money last as well?
No, they are. The difference is that they're generally sitting on large funds, and they have different management fees that they can go to cover their overhead and things of that nature. We're a relatively small group that's part of a much larger group. So for us, we really make money when the company's been acquired. Fortunately, we've had some really good acquisitions and public exits over the years, and that's boded well. But at the same token, those guys, generally, because they've got such a big portfolio, they can make a few mistakes. With us, we can't really make mistakes because it hurts us in our wallet a lot more. They have $200 million funds. If their $1 million investment doesn't go well, fine. They've got 50 other companies that they just invested in. Us, we invest in a handful of companies. So if we invest $4 or $5 million a year, if two of those deals go badly, well, not well. That doesn't sit well with me. So that's the difference, I think.
Matthew, if you can elaborate a bit more, what is the typical structure of the companies you invest in, like ICT, life sciences?
Yeah. So yeah, good question. So I mean, again, going back to sort of my key example.
Just the second part of the
Sure.
question is that what would be a typical investment that you invest in early stage companies, and out of the total, what's the percentage of the companies that are successful?
Okay, so as I mentioned before, I got a little bit ADD, so I won't be able to remember all of those questions. So the first question was
the structure.
The structure? Yeah, I mean, generally, again, going back to the sort of the Keek example, again, totally out of left field. It's a consumer app play. Generally, I have little to no experience in that space because I call it fatty investing. It's F-A-D-D-Y. 1 minute it's up, and then the next minute it's down. Historically, where I've done most of my transactions has been in software as a service, enterprise deals, where it's a widget, a business widget, business software, and it solves a problem. and you've got contracts, you've got recurring revenue, it's predictable, relatively predictable cash flow, you can manage your expenses. So historically, I've done SaaS, enterprise companies. Second part of the question.
Typical investment.
Size?
Yeah.
$1 million.
And out of the total every year, let's say like last year, how many were successful?
What's your definition of successful?
How many you invested in out of the total?
How many did you
Percentage
invest
wise,
last year?
yeah, let's say you got 100 out of 100. How many were successful?
Sorry, but how many were we pitched and we actually ultimately invested in?
No. How many pitched you and how many were actually successful in getting money?
Oh. I mean, we probably see north of 1,500 deals a year between myself and all of my partners. I mean, we see lots, and we probably invested last year, I don't know, 4?
4 out
Yeah.
of 1,500?
Yeah.
You're very picky, huh?
Yeah.
And Kiko is one of them.
And Keek was one of them. And again, it doesn't make any sense in terms of what we're looking for, but it was just one of these things where we took a flyer on it, and at the moment it seems to be working. So what we say to companies is, you be your kind of geek, and we're going to be our kind of geek, and we're going to be able to spend time doing what we do best, which is help the company from a governance perspective, build up the board of directors, help out with business development, help raise additional rounds of financing, ensure that the company is structured properly for an acquisition, all of the stuff that most entrepreneurs have, to be blunt, have even serial entrepreneurs have little to no experience or understanding of. That's what I think we bring to the table. Because we only invest in a relatively select few, we're not trying what they call a spray and pray model. I'm not trying to invest in 50 companies and hope 2 work out. I want to invest in 2 and 2 work out.
So does that translate into equity, or is it?
Yeah, so I mean, we do, again, because we're not a traditional fund, we generally can kind of do whatever we want in terms of the structure. You know, if we really like a management team or we really like a company, I'm more than happy to sit across the table with them and say, what do you need? Let's just try and figure out how to get her done. You know, it's as simple as that. It's just spending the time to understand what the pain points of the entrepreneur are and the management team, and to make sure that the right capital structure is in place for future growth and for future financing. That is very, very important from day one. So I'm going to give my next speaker a little bit of a plug here and say, make sure that you have the proper legal and financial governance structure in place from day one. That is so important. It's not the most important thing in the world, because obviously I personally think that revenues and sales are the most important thing. But at the same token, if you want to be acquired or you want to raise additional financing, having a clean cap table or a relatively clean cap table, for example, having a good legal structure, good governance structure in place, it just makes the transaction go that much more efficient.
That's it.
Thank you, man.
Thanks, guys. Thanks for having me.